Titan is concerned. Mayuresh Joshi is also joining us on the show. Mayuresh, let's begin with Titan itself. It's been a very steady performer, steady wealth compounder over many, many years. Do you expect this one to be a slow year for Titan going forward?
Afternoon, Nisha. Might be the case, but looking at the update that most gold and jewelry companies have given, including the likes of Titan and Kalyan, I think the numbers seem to be sustaining, at least as far as Q1 or the first half is concerned. A lot of the wedding season coincides in the second half itself. A large part of the jewelry market, 60% or more, is associated with the wedding season market itself. And to a large extent, the organized market is expected to grow at a compounded pace from 32% as the overall market should to almost 40% in the next 2 to 3 years. Somewhere, I think the first 2 quarters might see some slowness come through, but a roaring comeback can be expected in the second half itself. In terms of the market opportunity itself, the expectations in terms of the market size itself compounding at a pace of 9 to 10%, and with organized players probably gaining more strength, these become secular structural stories as this part of the story unfolds. So yeah, I think some softness might be expected on a sequential basis, but to a large element, I think over a longer period of time, Titan probably remains a good bet holding the portfolios.
Mayuresh, what's happening on Suzlon? You know, the market in pockets is quite excited about it. We've already seen a massive recovery from the lows, although on a very low base on Suzlon. And then there is that impending fundraise as well.
Afternoon, Aisha. So 2-3 things interesting happening for both Suzlon and Inox Wind. If you probably go back a tad bit in the periodicity of 2015 to 20, the input costs were significantly higher and the tariffs were a clear mismatch in terms of what these players were having in terms of their operating expenses. Therefore, I think a lot of the companies which were solely operating its wind business basically shut down. Now, with the new regulations coming through, expectations of 10 gigawatt getting added over the next few years, a lot of tendering activity, both from the public and the private side, expected to pick up steam. The expectations in terms of tariffs remaining extremely firm, with input costs very, very manageable at this point of time. The few existing players in the space at this juncture, including Suzlon, including Inox Wind, are probably going to be the biggest beneficiaries in terms of this regulatory change and move. Having said that, the interstate transmission charges, which have also been waived off, is a significant change in terms of creating a significant amount of operating margin improvement in their balance sheets, and therefore a lot of leverage can also get played out. A lot of debt, which was there on the books for a company like Suzlon, is expected to improve drastically in terms of both the capital raise that can probably come through, as well as improving cash flows as orders come in execution probably happen. So I think a lot of tailwinds, Aisha, for the sector, which is keeping stocks like Suzlon and Inox Wind in the moment.
So that's about Suzlon and Inox Wind. But Mayuresh, what's the view on the big one, Reliance?
So Anish, I think the developments which have probably happened in terms of the financials and also the partial buyback in terms of Reliance Retail, obviously it's accretive in terms of the earnings per share as well. If you probably map this along with the stock performance today, I think it's very logical in terms of Reliance showing a smart move in today's trade. But over a longer period of time, if you probably drag this up over the next 2 to 3 years, the expectations from an immediate perspective in terms of how Singapore GRMs will fare, Reliance access to multiple feedstocks obviously will ensure that it gets a premium to those Singapore GRMs. Having said that, I think the overall business perspective, both from retail and geo, is expected to show significant amount of improvement over the next few years. From an immediate perspective, again, sequentially, there might be some element of slowdown happening because you probably seen a very heavy base last year. But if you elongate, as I said, over the next 2 to 3 years, those earnings might actually start compounding. At the same time, the capex that Reliance is probably doing towards green hydrogen over the next few years, they're still confident of maintaining their net debt, net EBITDA to very, very manageable levels, even with the kind of output that they'll probably have over the next few years. So immediate perspective, maybe a little bit of a softness because of the heavy base, but structurally over the next 2 to 3 years, I think it is placed very, very well in terms of the entire ecosystem, both on the retail as well as its O2C business.
Mayuresh, what do you feel about the urban consumption trend? You think the earnings in Q1 will reflect that, or do you think the best is already behind us? And I'm going to include everything from a Manyavar to a Titan to the entire cluster, basically.
I think it is still holding up. For the better part of the last 6 to 8 quarters, the urban consumption has probably held up, and that's probably laid a lot of impetus in terms of the overall consolidated earnings for a lot of these retail discretionary players. I'll also put in Trent in that because Trent is largely a tier 1, tier 2 city kind of a franchise, which probably also indicates a lot of retail discretionary spending. But as I maintained, I think what you're looking at probably from FY22 to FY23, I think the base has become very, very heavy for a lot of these consumer-oriented companies. And therefore, to outbeat this in FY24 by a huge margin probably looks difficult. So I think this year largely will be a year of consolidation for a whole host of these retail franchises. I'll also put in the QSR players, even footwear companies that Sharad was mentioning. And therefore, a lot of these companies, if you look at management commentaries, Ayesha, for the QSR space or footwear companies, they're actually foraying into tier 3, tier 4 cities. A lot of retail, rural penetration has already started happening to probably diversify in terms of the urban concentration that they probably have. But to answer your question, I think it's probably going to be a year of consolidation because you're not going to see a significant earnings beat happen on an annualized basis for most of these players.
Bit of a consolidation, but Mayuresh, that doesn't seem to be the case for the new listings. I'm not sure if this is the case that the valuations have become, the promoters have become a lot more cognizant about leaving some, butter on the table for the retail investors as well. Or is it the fact that the market is pricing in a lot more? Because today as well, if you look at Sion DLM, a bumper listing, Idea Forge that happened last week. Are you looking at any of these IPOs positively?
So I think the moves have been pretty significant, Anish, at this point of time. But I think the valuations have now gone out of whack with the kind of move that we've probably seen. Just to put a point in perspective, I think the kind of rallies that we've probably seen in the last 2 to 3 months, I think there is a feeling of missing out. I think that FOMO feeling probably exists between a lot of retail investors. And therefore, the kind of participation that you probably see, look at the subscriptions that have probably come through for these IPOs itself. I think there have been crazy numbers for this element in the primary market itself. So I think one element, I think a lot of feeling probably coming through, which is drawing a lot of retail investors to take their bets in the primary market. But with the kind of moves that probably seen in a few of these listings that have happened, I think the valuations have gone out of whack. We should probably wait for pullbacks. Doesn't make sense at these levels.
Pocket which has been very active besides, of course, pure play auto majors has been the tires space. And I was just looking at the year-to-date performance of some of these stocks. Apollo Tyres, for instance, has shot up about 30% year-to-date. SEAT has given you a staggering 60% return. MRF has given a return of about 15%. JK Tyre up 35%. Balkrishna Industries up 9% as well. Mayuresh, go with the pure play auto majors, ancillaries, or a mix of both?
Mix of both, to be very honest, Aisha. Obviously, the few players like Bajaj and TVS, with the kind of response that they've now received, specifically Bajaj and Hero for their new launches, you're probably seeing sentimental moves. But if you map their 10-year standard deviations in terms of forward multiples, Bajaj at around 23 times, 10-year average around 17 and a half times, TVS around 28 times, 10-year forward average around 10-year average at around 21 times. Hero is probably more sanguine at this point of time. So wait for pullbacks. But tire makers become a very interesting story, I think, with the kind of new launches and the responses that they've received. But I think the OEM part, take the example of SEAT, which has moved significantly in the past 3 or 4 days. It services a lot of these two-wheelers. Take the case of Apollo or JK, servicing a lot of the PV and the MHCV players in the market, which is held up, both in terms of numbers as well as volumes every passing month. So the OEM part of the market is holding up pretty well. The replacement market was always the savior for these players, expected to continue doing well. And to a large element, input costs have gone down significantly, whether that be crude derivatives, nylon tire fiber, and of the likes thereof. And therefore, I think the margins can be pretty robust for a lot of these tire makers. So I think tire makers look interesting at this point of time. And a little bit of the auto ag space, something like a Minda Industries, which I've always preferred, also probably look very, very attractive from a reasonable medium term perspective.
In Mayuresh, is there any stock, any sector that is on your list right now, the top recommendations?
So, Nisha, a couple of names that we're probably looking at MarketSmith India. One from the pharma space, Zydus Life, looks pretty attractive at this juncture, where most pharma companies are grappling with every issues. Zydus probably received the green chit for its Ahmedabad SEZ. A lot of products, some critical ones with high margins, have been launched, expected to get launched in FY24 as well. Margins expected to remain about 23-24% odd. And the top line, bottom line growth, specifically the earnings growth, should be in excess of 18-20% that we track at O'Neill. So Zydus probably looks to be an interesting story. The other stock that we probably like is Tube Investments, a mix of both capital goods and autos as well. The expectations in terms of rollouts that can probably happen, specifically for its three-wheelers, expecting to get good traction. Its EHCV segment, expecting to roll out 30 to 50 trucks a month. And the Celestial, which is the e-tractor model, expected to roll out as well. Expecting a huge amount of traction coming in from these new businesses with better margins. For their core business in particular, the engineering business, exports expected to pick up with a very recent volume growth for FY24, along with their mobility business. The other two elements in terms of Crompton Consumer Power has done exceedingly well, and Shanti Gears, its subsidiary, really to probably account for a holding company discount, still adds to the SOTP value. So yeah, I think good balance sheet, good promoters, mixed Tube Investments, an attractive bet in our opinion at this.
One of the top bets. Yes, we did speak with the management at TI Clean Mobility, and they were talking about those heavy vehicles, saying that there is not much competition in India as of now. They are expecting some sort of production to start over the next couple of years. Even the passenger vehicle is very crowded and they're not looking at entering there. Three-wheelers is something that they've already started the production, and those electric heavy vehicles is something that they're expecting with the next couple of years, and that was the big lever for Tube Investment as well. That's how we are tracking the day as well. Sensex and the Nifty are actually holding up in the green, not by a whole lot, but just marginally so. It's the broader market which have been under pressure today, and the banking names too have been on the back foot today. Case in point being a couple of these private banking names, the likes of the likes of Axis Bank as well as IDFC First Bank. Bank of Baroda from the public sector banking space is also down. Federal Bank down about 1.7%. Mayuresh, within the banking pack, what are your top bets?
So at this juncture, we are liking Bank of Baroda. I think it's largely a consensus call as I see it, because when we're tracking it, I think a lot of analysts have a buy recommendation. But to a large extent, I think the elements that are in place, asset quality pressure is coming off quite significantly. NIMs might moderate from the 3.3% that they're reporting at this juncture, but still expected to roll out. The SMA1, SMA2 book is pretty low at 0.35%. And the provisioning, which is increased along with very strong CET1 ratios, actually position Bank of Baroda for good growth going forward. Our own sense is that the NIMs should stabilize. The pre-provisioning operating profit should compound at a very decent pace. And they have a very good mix in terms of both the credit deposit ratios as well as the expectations of cost income actually coming down. So I think our best bet in the banking space at this point is that.